All right. So yeah, so I think I'll just get started. So Paul apparently has some technical issues, but I don't think it should keep us from starting the webinar. So yeah, so thanks everyone for joining, taking the time. I think we have an interesting and relevant topic right now: history and future of revenue growth management, a little bit with a focus on consumer goods, but I would say many of the things we have are also applicable to other industries. Very quickly, before we get into the topic, your host today. So I'm Ingo Reinhardt, co-founder of Buynomics, long experience in pricing, revenue growth management, previously in consulting, and now with Buynomics for the past 4 years, looking at how to improve and pricing, revenue growth management, and turn it into a product for customers to use. This is our mission, and I think we're making good progress here. If he joins, I'll let Paul introduce himself very quickly, and just very quickly on the product. So what we are is a SaaS company. So we offer software as a service that covers all the key pricing challenges. You can use it for price optimization, for example. You can use it for product optimization, so what features your product should have, how to build a portfolio of different products. You can use the software for all of these, also manage your trade terms, optimize your trade terms, optimize promotions, and also in other industries look at customer lifetime value, use the solution to optimize it. And because we have developed a solution and built an underlying model that's far superior compared to typical price elasticity approaches and other things, we'll go into that. It usually yields significantly more profitable solutions than can be achieved with existing technology currently. And we're a German-based company, but we have customers around the globe and are looking to expand further. So we're a global company, so there shouldn't be any reason not to work with us if you're taking the topic seriously. So let's get started, and I hope that Paul joins at some point. Otherwise, we'll just keep going. All right. So before we dive into the topic, I think one observation that many of us have made this just yesterday or today on LinkedIn, is that we currently have a very strong inflation jokes. So they're everywhere, and that is something that I've observed. And I think when we get to the point where there's an inflation of inflation jokes, then there's some trouble. But I think for us in the pricing field, we are well aware of the topic of inflation, and I think our task is also, and to some extent, also an opportunity, important to manage the inflation that we're faced with at the moment. All right, hi Paul. I hope now your system works. All right, so topic of today, revenue growth management. And I think to get started, I think it makes sense to look a bit into the idea and understand why there is such a thing as revenue growth management and what's different with it than just simple price optimization. If we hear, and this is a very oversimplified representation, but I think it's helpful to get started in the topic. So on the left side, very simplified, if you sell a product, there's demand. With higher prices, demand decreases, lower prices, more demand. And somewhere typically there's a profit optimal price if you're just thinking of one price, and then the revenue that you can achieve is the box here at the lower left end of the slide. So, and you can optimize this with the simple price. You can optimize the revenue. For example, if you optimize the revenue as a single price, then price elasticity is -1 at that revenue maximizing price. If you are looking to maximize profits, then you have price elasticity times margin equals -1 in the profit optimal price. So you can do that. But of course, there are these two triangles here missing that are potential revenue, but that are not achieved in this case. And this is at its core what revenue growth management tries to achieve. So it is at its core about differentiation, to also capitalize on people with a very high willingness to pay, and also not miss the people, the customers with a very low price elasticity, with a low willingness to pay. And this is the core, and of course there are different techniques to achieve this. You can do this with price differentiation, you can achieve this with product differentiation, having, for example, different sizes of products. We all know this, but at its core, this is always what this is about. And while this looks very attractive to go from the square to the triangle here, there are also, and we've done this in previous webinars and white papers, we talked about this, there are some dangers. So for example, if you have someone here with a very low willingness to pay, and you offer that person a high price, he or she will not buy, and is maybe lost. On the other hand, if you have someone with a very high willingness to pay and offer that person a low price product, then you're losing a lot of the willingness to pay potential on this place. And so therefore you need to have a very good understanding of who has what willingness to pay to make the system work. So while it's very, very juicy, I think there's also a lot of dangers. And I think in a previous white paper, we compared it to a blowfish. So if you know how to do it, it can be very tasty, but it's also very, very difficult if you don't know how to manage it properly. So, and I would say historically, the industry that's best known for attacking this revenue management is in passenger air transportation, so selling seats on an airplane. It's obvious that, let's say you have 100 seats on an airplane. If you charge $100 per seat, you can have a revenue of 10,000. But there are some passengers that probably would have paid more than the 100, and if you can achieve that, that's of course very interesting. And the particular challenge here in transportation, and that's very crucial also for revenue management, is that in airlines you have a fixed capacity. So you can sell up to 100 seats, but you can't sell more than the 100 seats. So every person who takes a seat at a lower price, you can't sell at a higher price. And in this case, the typical observation is that over time, typically the average willingness to pay tends to increase. So people who are willing to pay more, for example, business travelers or people with an urgency who just buy a book a day in advance, they tend to have a higher willingness to pay. That's why typically prices increase over time in air transportation. But they might also, if, for example, you have overestimated the demand, the future demand, they might also go down at some point. Therefore, it's also part of the game to reduce prices maybe in between if you have overestimated. But in general, you have two things. You have limited capacity and you have passengers with differences in their willingness to pay, and you can sort of identify their willingness to pay by when they book, and customers that tend to book late tend to have a higher willingness to pay. That's why prices tend to go up. Another case is, for example, in fashion, where the willingness to pay goes down over time. You also typically have, particularly in fashion, is that you have a limited stock. So a store might buy 100 t-shirts of a certain type, and when they're sold, they're sold. And if someone comes who would have paid more than the last price, that person can't buy the t-shirt anymore. So typically in this case, you have, because for two reasons, you have a declining willingness to pay over time. So if something comes out and is new, then typically the willingness to pay of everyone is higher. Whereas if it's a piece of fashion that's already longer in the market, then it tends to go down. And also the people who have a particularly high willingness to pay tend to buy early. So they drop out of the market for a certain t-shirt. So because of these two effects, the willingness to pay goes down over time. And the way to react, the typical way to react is by giving discounts, maybe the first discount at some point, and then a last discount in the end. And all the t-shirts in this case that haven't been sold during the time probably have to be thrown away in the end, or can't really be used. So that's the idea. You have a fixed stock of shirts, and you have declining willingness to pay over time, and the task or the challenge is when to discount and by how much and in what form. So that's here also the case of revenue growth management. In two other fields, I have two more examples. One is consumer goods, which is of course closer to what we're here interested in, but a similar thing we also have in gas prices. Is that, and these two cases differ from the previous ones, would say, in two important things. One is that we don't have necessarily or typically have a fixed capacity. So prices for gas or consumer goods, or commodities go up or down, but there typically isn't a fixed capacity as in seats in an airplane. And the second one is that while there are effects like seasonalities, you sell more ice cream in the summer than in the winter and some other things, there isn't a strong trend overall in demand, in the sense that, or a small trend in the willingness to pay, as you have for airline tickets or concert tickets, as you move towards the date when the flight takes place, or towards, in fashion, the end of the season. So you don't have these trends and you don't have fixed capacity. So those were the original reasons why we have this growth management. But here we have similar effects. So for example, in Germany, I know this for sure, is we have gas prices, they decline throughout the day and then they're increased late at night. Typically when the smaller gas stations close, like the larger ones, the Shells, Esso and so on, they increase their prices. It's about 10, 15 cents throughout the day. And this allows the market also to differentiate a bit and capitalize on people with a higher willingness to pay, because people who are more price sensitive, they will self-select and come later, so you don't lose them in the morning. They can come in the evening and buy at a lower price. People who are less price sensitive, because, for example, they're business people, they're in a hurry and they need to get to a customer, they will they will fill up their car whenever it's empty. So this also allows the supplier, the gas stations in this case, to benefit from price differentiation. And the same is true in consumer goods when we talk about promotions. Promotions attract, and this is what we indicated here with the dip in the average willingness to pay. With promotions, allows you to also address customer segments that are have a lower willingness to pay than the average, and you can benefit from those. And of course, in reality, so this is still very oversimplified, this is a bit more complex, because in particular here in consumer goods, we're not just talking about the price of a product or the promotion of a product, but we have the full complexity with competitor products. You have maybe two competing brands, A and B, and they have promotions not at the same time, but alternating promotions, and that adds significant complexity to the system. And the typical questions are, does it make sense to work with promotion, or would it be better to have something like an everyday low price against your competitive environment? Overall, there are tons of questions we're all very familiar with: pricing, pack price architecture, how to work with promotions, and to organize all of this across categories, channels, and in some cases even between countries, and all that within the context of macro shocks, such as increase in inflation as we have right now, or as we had with the pandemic previously. So this is overall, in the beginning, I think what we laid out, where the idea of revenue management comes from, very neat supply and demand graph, but in reality, it's much, much more complicated than that. And what we saw, and what was essentially the reason for founding Buynomics, is that the typical toolkit to manage this complexity is not really up to the tasks. So things like very simplified cost plus pricing or competitive pricing, where you just price relative to other prices, is, I think, obviously not very differentiated. It's not clear why you should have a certain markup against your cost or your competitor. tools like a price elasticity are for anyone who has computed price elasticity, him or herself knows that this is a very rough task where it's often not clear. If you look at the cloud of data, typically weekly sales volumes against price data, in which direction the regression curve should tilt. And so these are very rough measures, and the same something like a value pricing where you say, okay, we build up a system where we have a product, in this case here, if you can see it, a ski jacket, and it has different types of fillings. It's more or less waterproof, and based on that, the price is defined as essentially a markup or markdown scheme. And often what at the end people also consider are some behavioral effects, price thresholds, and so on. And so there's a vast array of different tools available in the field. But what we see is that in many cases, these are not properly compatible. So if you have something value-based pricing, it's not clear how that should relate to a price elasticity approach. Who should win in the case when they indicate different price recommendations. Something like a price elasticity doesn't work well with a price threshold, for example. So there are many of these challenges, and that's why we find, and also that's why we founded Buynomics, is that these traditional tools are not properly compatible with each other. They don't work well together. And they are not very fit in dealing with the complexities that we're dealing with in real life situations. And so far we've talked, I think, about the history and the current state of revenue growth management. We're now turning a bit towards the future of revenue growth management, why we see, or why we developed a new approach. And I think this is the core of what can make the future of revenue growth management work, is that you have at its core a method that's capable of dealing with the complexities. And I just want to outline very briefly how we are thinking about that, and then show you in a very simple example what that means. So what we do is, and what I think is the way forward here, is something what we call the virtual shopper. And the idea is to create a very large set of these virtual shoppers. They have preferences for different brands, for different products and categories. They can have preferences for different channels and switch between channels. They can have, they can be rational. They can be behavioral people, in the sense that they are susceptible to price thresholds and so on. These people are then used as a model for what real customers in a store would actually do. So you typically based with empirical data, they are parameterized and then behave just like real people, and you can show them different offers. So here, like a good, better, best offer in this case, and they make decisions just like real people, and that allows the user to solve all the issues we had in the previous that we highlighted in the previous slide. So by counting the number of these virtual shoppers who would buy a product at a certain price or different price points, you get something like a price elasticity, you get the demand functions, you can compute revenue profit effects, so you can manage and grow your revenue as is the task in revenue growth management using something like that. And they properly get the trade-offs between different products right. So a system like this understands if you price, let's say, 5% above a competitor, what that means, what share of people still buy your product. If you price 10% below a competitor, how much do you gain? If you have pack sizes 100, 200, 300 versus 100, 200, 400, for example, it tells you how customers split between these products. So, and with this, you can essentially model the full complexity that's relevant in a market. And I think, Paul, are you actually there, or am I still alone?
No, I'm here. I'm just in your head.
Okay, perfect. Hi, Paul. Just give me, still have enough time, right? I'll just share a different screen here. Where is it? Okay. Can you see it, Paul?
Yes, we can see it.
So perfect. So yes, so this is a simplified example that I've used a few times. So here we have a product portfolio, 4 different products. We have 3 competitor products in the market. We can look at different product sizes. So we have here our own brand. We can build products with different brands, can set up our discount system, our list price and everything. You can remodel essentially the full market that's relevant. And then, as I explained before on the slide, show these products, our 4 own products plus 3 competitor products. And we see what happens if we change a price. So we increase the price here 20 cents and we lose 170 units, but some of them go to our own other products and we lose some to a competitor. So with something like this, you can have the full transparency in a market. So for example, you have the demand curves for the different products as we showed on the slide, you know, the revenue, the profits. You can also look at price elasticities if this is what you're interested in. And with this system, you can essentially model the realistic complexity and look at things like, here's a simple example where you move from a base case to a case where because on commodity price inflation, your commodity prices increase by 25%, by 20%, and to see what effects that has. So if only your cost increase, you don't do anything, then of course your units stay the same, and your revenue also stays the same, but your profits decline because you have higher COGS. So you see that, and the question is, what can you do to react to that? So you could, for example, increase all your prices by 20%. This is this case. And in this case, all the competitors also increase their prices by 20%, or if only you increase your price, your competitors don't follow, this is what happens. Or you can degram all your products by about 20%, so from 250 to 200, from 1,000 to 800. So you can look with a system like that at the full complexities that are relevant. Here, as I said, a simplified example, but you can also but you can also use it to answer all the actual questions you might have. So here's a simple example of a company. This is based on a real case. Numbers are anonymized, but the graph looks the same. So it's a company that had on and off promotions, and then at some point moved to an everyday low price strategy. And this is what also was recommended or was predicted by the solution here. What would happen? There's still some ups and downs in this case because, of course, the competition didn't change the strategy. So when the competition still was on a promotion, then also with an everyday low price, you were selling less, whereas when the competition was not on a promotion, then you had a chance to sell more, and there are some special selling events in this case. So what I'm saying is that with this system, you can actually manage the full complexity, and I think this is also a key part of the future, at least as we're seeing it, that and what we're building is a system that allows users to manage the full complexity required to do revenue growth management well in one place, and essentially within one system where you have the full overview of what's going on in your market, have an overview, simple dashboard with tasks and the effects of everything, and gives you the opportunity to dig deep here, upper left corner, for example, into the details of what's going on in your market, where you can define your promotions overall if you want, but also within a sales department, manage promotions on a week-by-week basis and understand what effects that has within each week, and use in overall the system to optimize sales. Not roughly, we want to increase price 3%, but you can optimize your pricing together with the portfolio strategy and your promotions, essentially on a week-by-week basis. Of course, people won't do that by hand, but this is something that's strongly supported by the technology that we're building, that gives you the opportunity to identify the best approach in every week. And this is, I would say, how we're seeing the future of revenue growth management. And Paul, I think we have a couple of questions.
Yeah, we do actually. So we have three very interesting questions. The first one was in the Q&A. Someone asked, how do you set up the virtual shopper data? So I guess this is about the method, and can you maybe just describe what data goes in?
Yeah.
And
yeah. So it's essentially two things. So it's a base model of human behavior. So how people make purchasing decisions, essentially based on their utility. It can consider, where it's relevant, behavioral things like price thresholds, or a certain share of the population, or if you have 100 people, a certain share of these are susceptible to price thresholds, some are not, and these things can be considered. You can actually turn them on and off. And also other things, so people, if that data is available, tend to buy products that are on a certain shelf with a higher probability, or then these things can also be modeled. Or if we showed the good, better, best offer, many people tend to buy the product in the middle if you show them 3 products, and these things can all be modeled. And it's done, as I said, with a base model, so how customer behavior works in general, and that's then parameterized with the context-specific data. And this is, in most cases, in consumer goods, our sellout data, for example, on a weekly level for retailers. And these are used to parameterize these virtual customers. So essentially looking at the past. So how are the customer preferences between different brands for different pack sizes and so on, to produce the outcomes that have been observed. So the sellout data is most important, but also all the other typical pricing data can be used, like surveys, certain studies, panel data, and so on. So everything that's typically used can be integrated here, but in most cases, the sellout data are already sufficient for a very good picture of what's going on.
all right, thanks, Ingo, for that first answer. Someone is also asking in the chat, thanks for the webinar and the interesting info. The scenario-based analysis you lay as the future of RGM in reality is measured through conjoint and household panel data, or is this data source different? Maybe you can speak a little bit about where our data is coming from and how it's different from these market research approaches.
Yeah, so conjoint and panels, they're of course very useful tools, but what we found is that essentially the same can be done with, or something very similar can be achieved with sellout data. If you look at the actual sales, for example, on a weekly basis, you typically have a lot of variation because you have promotions on and off, you have changes in pricing, you have changes in pack sizes, products that are only in the market in some weeks, and so on. And with all this variation, it is similar to the variation that's been produced when people are participating in a conjoint study, and it can also be used to achieve similar insights on customer behavior. It has some advantages, some disadvantages. I would say the key advantages of sellout data are that it's more honest, because that's what people actually bought, and you have much more situations. Typically, we work with something like 3 weeks, so you have 3 years, so you have 150 weeks roughly, and times a large number of retailers. So you have more than 1,000 buying situations that are assessed by the algorithms we use, and therefore then in the result produce similar insights, often more honest and more precise than what you would get from a conjoint. So we can replace conjoints, but we can also in some cases improve the results using the conjoint data or panel data.
Super. Someone else is asking, could you measure competitive response historically and highlight the likely market response scenario?
Yeah, so currently the focus is mostly on the consumer or shopper reactions. Competitor reactions are a bit more difficult, of course. It's in the end it's difficult, in some cases impossible to predict what a specific competitor will do. But what we have is you can identify based on past behavior how certain competitors behave in the market. So some will, I don't know, always increase 2% each year, regardless of what happens, or maybe now a bit more in inflation. Some will always follow a certain other competitor. And based on these past behaviors, we can provide insights into how certain competitors behave. And also what's always the case is what makes sense is to look at certain scenarios. I think as I highlighted in the short example I showed, where you can say, okay, what happens if I increase my prices without competitors following? What happens if I increase with competitors following, and so on? So this is typically the best approach, but in the end, no one can definitely predict how a specific competitor will react. But what can be done is work with scenarios, and this is, I would say, the best approach here.
Great. So let me just check some of the questions here. There's a lot, so some we might just have to answer by email. So someone else is asking here, your examples are mostly CPG related. How about some more slow-moving goods, such as B2B, etc.? Can you talk a little bit about that?
Can you just I didn't catch everything on B2B.
So someone's asking, the examples are mostly CPG related.
Yeah.
How does the tool work, or how do you view something like a slow-moving item like spare parts in the B2B context?
Yeah. So these are different things. So CPG is where we're starting. We have a number of industries: CPGs, software, telecommunications, where we mostly focus on at the moment, but we have also tested the solution in other areas. So B2B, what makes B2B specific is that you typically have customer specific prices and offers. This can be addressed. Then of course you don't have for a specific customer, you don't have like a sales number, but you have like an expected probability at which you close a deal, which gives you an expected profit and expected revenue and so on. So this can be done. It's something that we haven't focused on, but that's possible with the solution. And the same is with something like with slow-moving products like spare parts, where you have to work with different techniques. But in general, it works. But these are areas that we haven't focused on, or are not focusing on at the moment.
All right. Someone is asking, what sources, books would you recommend? Maybe we can send them a list of recommendations in the follow-up email. What do you think, Ingo?
Yeah,
Great.
that makes sense. I think we have something like that.
Perfect. So someone's asking a very interesting question. What's the validity of the insights with the level of inflation being observed currently?
Yeah, I think we're already a bit over time. We've done a webinar on inflation recently. Maybe we can also put that in the links where we address that question on also how inflation works in reality and how that works, how that's been modeled within the solution here. I think that's more helpful.
That's a good idea. Let's share that in the follow-up email. So just check your inbox, and then we'll we'll send that through. I think that's all we have time for now. I think there's some more questions. Does the tool enable input of marketing spend assumptions in addition to trade hours and competition to deliver enhanced insights? Maybe just a two-sentence answer, Ingo.
In general, yes, but it has to be measurable, right? So there has to be a link between marketing spend. In some cases, like when you sell Google Ads or software through Google Ads, that's very straightforward, where you have a direct understanding of how much what's the benefit of marketing spend, whereas if you just run TV ads, this is a bit more tricky to understand how that affects sales, but in general that can be done, yes.
Okay, and then maybe the last one, if a company only has sell in and out data within the value chain, but no sell out data to the shopper, does the solution work, or how does that work?
This is a bit more tricky. It depends on how much transparency you have towards the end customer. Otherwise, the focus would then be on how you sell, for example, to a wholesaler, to a retailer. And this is more similar to the B2B context, where maybe you have different retailers, at certain prices or certain offers, they make certain purchases, but you don't know what they do with these products in the end, or so at what price they sell. So this always depends on the case. What works very well is if you're in a mixed context. So you have, I don't know, we're talking about CPG companies here. In some companies, very good data, sell-out data, and in other countries you don't. You can use the insights from the countries with sell-out data and apply them to the countries with only sell-in data. To understand how that would work towards the end customer. So that can be done, but it can't give a general answer, but happy to discuss.
Yeah, and then last question, someone's asking about a very specific market that they probably have in mind. If your market is filled with a few big and many small competitors, and the services are priced by contract and fixed for a specific period, sounds like it could be, for instance, in some of the telco contexts, then how would the model work? So I guess the question is if there's few historical changes to be observed.
So the model works without too many price changes. So in telco, for example, you often have like same price points here in Germany, I don't know, 19, 29, 39 euros, but you have changes underneath. So how much gigabyte you have, what other services, discounts, and so on. So if there's other variation that is sufficient, but I would have to say that in the specific case to understand.
Okay, great. I'm just answering someone's personal question here, and maybe Ingo, if you can go to the next slide, just outlining our next webinar on stagflation.
I think I already did. Do you see it?
On mine. No, there it is. Perfect. Yeah, so our next one is in 2 weeks. Talking about stagflation, so inflation with a recession over a longer period of time, and what that means for commercial decisions. So quite an interesting one, and yeah, looking forward to seeing a lot of you there. Check your inbox on Monday and Tuesday for the follow-up email where you can register for this. You receive the PowerPoint or the presentation from this webinar, the recording, and we'll also add some book recommendations and the link to the next webinar. So see you there.
Thank you very much. Have a good weekend, and yeah, speak in the next webinar, I think already in 2 weeks.
Yeah, exactly.
Thank you.
Thanks.